Welcome to the Pro Ticker Deep Dive. We are looking at the wild, frankly, whiplash-inducing market dynamics of early March 2026.
Yeah, whiplash is definitely the right word for it.
Right. I mean, if you're watching your portfolio right now, you are likely noticing these incredible, almost historic levels of intraday volatility.
Oh, absolutely.
And you might be sitting there wondering how on earth global conflicts, shifting interest rates, and these massive commodity spikes all actually connect.
Because it really does feel like the markets are they're moving in 10 different directions at once right now.
Exactly. So our mission today is to connect those dots for you. We're bypassing the surface level panic, ignoring the noise, and just looking purely at the factual market data and the widespread analyst consensus to understand the actual plumbing of the financial system.
And there's a lot of plumbing to go through.
Okay, let's unpack this.
Yeah.
We have to start with a massive geopolitical shockwave in the Middle East, right? And its immediate impact on the markets.
Yeah, you really have to start there. It's the necessary starting point because geopolitics has just completely hijacked the fundamental macro narrative over the last few weeks.
Really?
What we've been analyzing in the data is this classic, albeit pretty extreme market reaction to a sudden global conflict, specifically the U.S. military operation in Iran.
Right, and the immediate consequence of that operation was the effective closure of the Strait of Hormuz.
Exactly. Which, for anyone tracking global energy markets, you know that is the ultimate systemic choke point.
Yeah, I mean, roughly a fifth of the world's daily oil consumption passes through that specific corridor.
A fifth. Think about that. So when that strait is threatened or, actually closed, panning is just the default setting.
For sure.
Not just for human managers, but for the algorithmic trading models, too. We saw oil prices instantly gap up, spiking well over $100 a barrel in just a matter of hours.
Insane. And we know that when oil breaks that $100 psychological barrier, and the technical barrier, too, the effects don't just stay isolated within commodities.
No, not at all. It acts like a massive regressive tax on the entire global economy.
Right. It bleeds into transportation logistics, it compresses manufacturing margins, and ultimately it just completely obliterates the consumer's discretionary wallet.
Yeah, the consumer pays the final price. But here's the critical pivot in the data that we really need to scrutinize.
Right around March 9th and 10th.
Exactly. The consensus narrative just flipped upside down.
President Trump signaled that the operation is actually nearing its conclusion.
Right, which is wild because this timeline is running well ahead of the initial 4 to 5 week estimate that the Pentagon and, all the major market analysts had originally priced into the risk premium.
And suddenly the administration is floating these proposed off-ramps.
Yeah, plans to waive specific oil-related sanctions.
And even deploying the U.S. Navy to escort commercial tankers safely through the strait.
Purely to keep those global oil prices in check.
But I have to play devil's advocate here. Is the market actually buying this de-escalation at face value? Or are we just seeing short covering by traders who got caught completely offside?
That is the exact debate happening on institutional trading floors right now.
Yeah.
You have to remember, the market is fundamentally a forward-looking discounting mechanism.
Right.
It doesn't price in today's headlines. It attempts to price in the probabilistic reality, say, 6 months from today.
Makes sense.
So as soon as the administration signaled these logistical off-ramps, specifically the Navy escorts, we saw this violent repricing event. Trading desks are colloquially calling it the taco trade.
The taco trade. Wall Street never fails to come up with a catchy acronym for absolute chaos.
They really don't.
Break down the mechanics of what that actually stands for and how it moved the needle.
Sure. So TACO stands for Trump eyeing the exits.
Oh, okay.
What's fascinating here is how quickly the risk management fire alarm on the trading desks was just manually turned off.
Because usually, when a major conflict erupts, especially one threatening oil, the algos go into immediate capital preservation mode.
Exactly. They dump high beta equities, they aggressively short consumer discretionary stocks, and they just bid up energy futures to the moon.
But the moment the taco trade became the statistically dominant narrative in the natural language processing algos.
It was like someone hit a massive reset button on global liquidity. Within hours, literally hours, oil experienced this massive 10 to 11% drawdown.
I was watching that. We tracked Brent crude falling all the way back down to the $87, $88 range.
And WTI West Texas Intermediate plummeted to around 83.
Which is not just a dip. That is a violent structural unwinding of a geopolitical risk premium.
It is the equivalent of releasing a pressure valve on the entire equity complex. You could see the bid-ask spreads tighten up and just this collective relief wash over the indices.
We watched the S&P 500 swing aggressively back into the green. It rallied all the way up toward that highly contested 6,826 level.
Yeah. And digging into the retail sentiment data, it's really fascinating how everyday investors are interpreting this macro environment.
If you scrape the retail trading message boards right now, the prevailing thesis is that the broader stock market is simply acting as a giant inverse oil ETF.
Which is honestly a pretty astute observation. The retail crowd has correctly identified the current dominant correlation.
Right.
In this specific macro regime, the correlation between energy and equities is almost perfectly inverted.
When oil shoots up due to conflict fears, stocks drop heavily.
Because the market instantly prices in the implied inflationary pressure and the subsequent margin destruction for corporate earnings.
But the moment oil plummets on the taco trade de-escalation news, stocks rally aggressively.
Exactly. The complex multivariable equity market has just been temporarily reduced to trading on a single geopolitical headline variable.
Okay, but let's push on that logic a bit. If oil drops 11% and the S&P rallies back to 6,826 because the world is suddenly perceived as, less dangerous.
Right.
You'd naturally expect traditional safe haven assets to sell off as well, right?
It would be the standard playbook, yes.
If the systemic risk is unwinding, capital should flow out of the bunkers and back into risk assets. But that leads us directly to the most staggering divergence in the market data right now.
It really is staggering.
We are witnessing this brutal competition between the two ultimate safe havens, the US dollar versus gold. And they are telling two completely different stories.
Yeah, this divergence is where the macro narrative transitions from a standard geopolitical reaction into a deeply complex, historic, structural shift.
Let's isolate the US dollar first, specifically tracking the US dollar index, the DXY.
Good call, because as we know, the DXY is not an absolute measure of the dollar in a vacuum. It's a relative basket.
Right, and it's heavily skewed by the euro.
Very heavily. The euro makes up a massive 57.6% of the index. You also have the Japanese yen at 13.6%, the British pound at 11.9%, the Canadian dollar at 9.1%,
The Swedish krona at 4.2%.
and the Swiss franc at 3.6%.
So when the financial media blasts that the dollar is strong, we really have to remember they're largely just saying the dollar is strong relative to the euro.
Exactly. And by extension, the European economy. That is a critical distinction to make.
So let's trace the intraday price action of the DXY over the course of this conflict.
When the initial oil shock hit and Brent breached $100, the DXY spiked to a 14-week high. It neared that 99.68 resistance level.
And this aggressive upward move was driven by two distinct mechanical forces, right?
First, you have the classic global dash for cash. In an acute liquidity crisis, global institutions, sovereign wealth funds, clearinghouses, they all demand the most liquid asset on Earth to post collateral.
Which is the US dollar.
Always. Second, you have the underlying plumbing of the petrodollar mechanism.
Because global oil is priced and settled in dollars.
Precisely. So a spike to $100 a barrel means importing nations mechanically require more dollars to purchase the exact same volume of energy.
That creates an artificial forced bid for the dollar.
Which drives the DXY higher.
That mechanical bid makes perfect sense. It's just structural demand.
Yep.
But then the taco trade hits the tape. The administration signals the Navy escorts. Oil drops 11%, and that mechanical demand for the dollar evaporates.
And we saw the DXY drop sharply right back down to the 98.6 level.
War fears fade. Oil drops, dollar drops. Standard market plumbing.
Standard.
But here's the massive anomaly in the data that we really need to tear apart.
Yeah, let's get into it.
Contrast that expected dollar drop with gold trading under the ticker XAUSD.
Despite the fading war fears that absolutely should have cooled the precious metals market down.
Gold completely ignored the geopolitical de-escalation.
Completely ignored it. It surged right past $5,200 an ounce, printing highs near $5,242.
Why on earth is gold completely ignoring the de-escalation narrative that just wiped 11% off the price of crude?
Because we are witnessing a fundamental rift in traditional safe haven logic.
Explain that.
Gold is currently winning the secular battle for the long-term safety bid over the US dollar. And it's doing so by looking way past the immediate geopolitical headlines.
Right, looking at the fiscal mechanics instead.
Exactly. We have to analyze those underlying fiscal mechanics. Yes, high energy prices might support the dollar mechanically in the short term through that petrodollar plumbing we just discussed.
But structurally, sustained high oil prices are incredibly destructive to the U.S. consumer.
And crucially, to the U.S. Treasury's fiscal position. The smart money is no longer trading the Iran conflict. They're trading the fiscal aftermath.
Let's expand on that fiscal aftermath. Because if consumers are paying a massive premium at the gas pump and for heating their homes.
That capital is instantly deleted from the discretionary economy.
Exactly. They aren't subscribing to new software, they aren't buying durable goods, and they certainly aren't propping up the services sector.
It acts as a localized recessionary trigger.
And the institutional market is always looking past the immediate horizon.
Sovereign wealth funds and massive asset managers are looking past this immediate Middle Eastern conflict toward a highly probable U.S. recession.
We really have to look at the domestic data here. U.S. unemployment is currently sitting at 4.4%.
And in the context of the Federal Reserve's mandate, 4.4% is a level that triggers severe anxiety regarding a stalling, nonlinear deterioration in the labor market.
So institutional investors are modeling out a softening U.S. economy paired with massive, continuous government debt issuance to fund these exact types of military deployments.
And domestic deficits. In response, they're making a profound structural choice. They are actively choosing to park capital in the unprintable physical asset gold rather than the world's traditional reserve currency.
Which implies a staggering shift in global market psychology.
It does.
I mean, if international capital begins viewing U.S. fiat currency as less of a pristine safe haven during conflicts that the U.S. is directly involved in, what does this actually mean for global liquidity moving forward?
Are we looking at a permanent impairment of the dollar's premium? It strongly suggests a gradual but powerful decoupling. If we connect this to the bigger picture, historically, a geopolitical crisis meant a blind, reflexive rush into U.S. treasuries and the dollar.
It was automatic.
Completely automatic. But if that reflex is broken, if global capital decides that the dollar now carries too much inherent fiscal or political risk, then global liquidity becomes deeply fractured.
It means the U.S. Treasury will be forced to offer higher yields just to finance its debt.
And it means physical, bearer asset commodities will command a permanent structural premium over fiat currencies.
So this $500 to $200 gold price is not a speculative bubble.
No, not at all. It is a very cold mathematical repricing of fiat counterparty risk.
Wow. So if the dollar is the foundational bedrock of the global financial system, and it's suddenly showing structural cracks, gold is the reinforced steel that institutions are rushing to acquire.
Exactly.
But who exactly is doing the buying here? I mean, you don't get gold to $5,242 on retail volume.
Definitely not.
Let's dive deep into the anatomy of this $5,200 gold bull market, because the data here is genuinely historic.
To truly comprehend the scale of this move, you have to look at the long-term statistical context. Gold has posted consecutive record-breaking monthly closes.
Which is incredibly rare.
It's a profound statistical rarity. If you look back over the past 45 years of market data, consecutive record-breaking months for gold have only occurred twice.
Twice in 45 years.
Right. The macro drivers pushing this metal are enormous. And as you correctly pointed out, this is not being driven by retail day traders flipping short-term call options.
No.
This price action is being engineered by the largest, most patient pools of capital on the planet, sovereign central banks.
Central bank accumulation data is staggering right now. Emerging markets central banks, in particular, are essentially vacuuming up physical gold from the global markets.
Just look at China's behavior. The People's Bank of China has increased its physical gold reserves for 13 consecutive months.
13 months. That's not a trading strategy.
No, that is a deliberate, state-sponsored mandate to diversify their reserve assets away from the U.S. dollar and Eurocentric clearing systems.
But I wonder, is this purely an economic calculation for them, or is this preemptive geopolitical positioning?
Honestly, it's inextricably both. Emerging markets watched the weaponization of fiat reserves over the last few years and realized that holding U.S. treasuries exposes them to extreme jurisdictional risk.
Which creates this fascinating, almost tragic divide between retail behavior and institutional strategy.
It really does. While central banks and massive institutional buyers are utilizing any minor intraday dip in the price of gold to load up on more physical assets.
The retail sector is completely disconnected from this wealth preservation strategy.
Completely. In fact, broad market data shows an alarming and accelerating trend of everyday Americans actively draining their 401k retirement accounts early
Just willingly taking the massive tax penalties and early withdrawal fees.
just to access liquid cash today.
That specific data point, the 401k drain, is a massive red flag for the domestic economy.
Matt,
It reflects incredibly deep systemic consumer stress. It means the savings buffers built up over the last few years are entirely exhausted.
yeah, there's no cushion left.
So we have this incredible dichotomy. While the retail consumer is forced to liquidate their future compounding wealth just to pay for today's inflated cost of living.
Sovereign nations are actively liquidating their fiat dollars to buy a permanent physical anchor.
It really highlights the disparity in how inflation impacts different tiers of the economy.
It's a totally different reality depending on where you sit.
And speaking of inflation hedges, this naturally brings up the broader alternative fiat conversation that dominates so much of the current market discourse.
Oh, yeah.
Everyone constantly compares gold to Bitcoin and silver. If we look at the tape right now, Bitcoin is trading around $71,400 and silver is trading around $90.
Right.
How do these three assets actually compare when we strip away the ideology and just look at the raw quantitative data?
This is where we have to completely abandon the narrative and look strictly at the hard volatility metrics, because volatility tells the true, unvarnished story of risk-adjusted returns.
Okay, lay it out for us.
If we analyze these assets over a rolling 30-day basis, gold has a volatility metric of roughly 13.6.
Okay, 13.6 for gold.
Now, silver, which has a dual identity as both a precious metal and a highly cyclical industrial component, its volatility is roughly double that of gold, sitting at 25.1.
Double the volatility.
Yep. And Bitcoin, which remains the ultimate speculative digital asset, has a massive volatility profile sitting all the way up at 52.0.
Man, 52.0. Let's unpack those numbers because that is a massive spread.
It is.
If Bitcoin is almost 4 times as volatile as gold on a rolling 30-day basis, what does that actually mean for a portfolio manager who is mandated to preserve capital during a crisis?
Right. How does that volatility profile dictate institutional adoption?
Exactly.
Well, it completely dictates it by defining the difference between a left-tail hedge and a right-tail asset.
Walk us through that difference.
So, in statistical distributions, gold acts as a classic left-tail hedge. The left tail of a return distribution curve represents extreme negative systemic stress.
Like a sudden market crash, a banking sector failure, or a global war.
Exactly. Gold is mathematically proven to provide stability and preserve purchasing power when the underlying system itself is fracturing.
Whereas Bitcoin and silver.
They behave as right-tail assets. They offer explosive, higher volatility, and massive speculative upside when macroeconomic conditions are favorable.
Or when central banks are actively flooding the system with excess liquidity.
Right, but, and this is the crucial part, they will absolutely punish a portfolio with deep, vicious drawdowns when liquidity tightens or systemic fear spikes.
Here's where it gets really interesting, and the historical data perfectly illustrates your point.
Let's hear the data.
When you look at the performance data since 2016, Bitcoin has experienced 30 separate months where it lost more than 8% of its total value in a single month.
30 months.
30 months of massive drawdowns. Silver has had 9 of those severe drawdown months in that same time frame.
Then gold.
Gold has only had one single month where it lost more than 8% since 2016.
Just one.
Just one. When you frame it like that, it makes it crystal clear why central banks are hoarding gold and not crypto to back their national reserves.
It's just simple math for them.
You simply cannot underwrite a sovereign nation's currency or manage a national balance sheet with an asset that might drop 10% over a holiday weekend because of a shift in algorithmic sentiment.
Precisely the point. Sovereign central bankers are the ultimate risk managers. They are not venture capitalists.
Right.
They are not looking for a 10x asymmetric return on their reserves. They are mandated to ensure the preservation of purchasing power with absolutely zero counterparty risk.
So this steady, relentless accumulation of gold by the official sector isn't just about sidestepping short-term dollar volatility.
No, it is a massive, structural, and deliberate hedge against a specific macroeconomic nightmare that keeps central bankers awake at night.
And we know exactly what that nightmare is.
We do.
It is stagflation. The dreaded S word has returned to the forefront of institutional research notes.
It's the ghost of the 1970s coming back to haunt the modern, hyper-financialized market.
We know stagflation is characterized by stagnant economic growth, stalling GDP, rising unemployment, shrinking corporate margins, combined with persistently high, sticky inflation that destroys the consumer's purchasing power.
But the modern context is what makes this so much more terrifying.
Right, because in the 1970s, the U.S. debt-to-GDP ratio was roughly 30%.
And today, we are operating in a system with historically unprecedented sovereign debt loads.
Which raises a really important question regarding the Federal Reserve's actual capability to fight this.
Stagflation is the ultimate lose-lose scenario for monetary policy.
Because if the Fed chooses to aggressively raise interest rates to kill the inflationary impulse,
They will inevitably crush whatever anemic economic growth remains, triggering a deep, cascading recession.
and potentially a sovereign debt crisis due to the higher interest expense on all that debt.
Exactly. Conversely, if they capitulate and lower interest rates to stimulate the stalling economy,
They essentially pour monetary gasoline on the inflation fire.
completely destroying their credibility and the purchasing power of the dollar.
We are seeing this acute fear exacerbated right now by the lingering effects of recent supply chain disruptions and these massive, unpredictable energy shocks emanating from the Middle East.
And the data shows this fear playing out in real time through the aggressive repricing of Federal Reserve interest rate expectations.
Let's look at how wildly the consensus has shifted on that. Just a few short weeks ago, the market was absolutely convinced that multiple rate cuts were locked in for the calendar year.
People were so bullish on cuts.
Equities were rallying on the assumption that the era of cheap, accommodative money was right around the corner. But if you look at the Fed funds futures today,
The markets have drastically repriced reality.
they now anticipate only a single, meager 25 basis point cut for the entire year.
And they are pricing the highest probability of that solitary cut all the way out in September.
That is a brutal, violently hawkish repricing of expectations.
It is, and it has profound implications for every single asset class. It means the cost of capital, the discount rate applied to all corporate earnings and consumer borrowing is going to remain restrictively high for much longer than the market consensus wanted to believe.
Yeah.
And if we connect this to the bigger picture, we have to factor in the added layer of extreme uncertainty surrounding the Federal Reserve's upcoming leadership transition.
Right, the nomination of Kevin Warsh to serve as the next Fed chair.
That introduces a totally unpriced variable into the equation.
Markets inherently despise uncertainty.
They hate it. And introducing a new Fed chair means introducing a new monetary philosophy, a new reaction function to incoming economic data, and a totally new communication style that Wall Street's natural language processing algorithms just haven't calibrated to yet.
Let's expand on the Kevin Warsh factor for a moment. If the market algorithms are used to the current regime's specific phrasing and forward guidance,
Which they are.
a new chair, who might lean more historically hawkish or who might prioritize different data sets, could completely upend how the bond market trades on FOMC days.
Absolutely.
And we can't look at the Fed in a vacuum either. How are other major global central banks handling this exact same stagflationary pressure?
Because Europe is facing the exact same energy shock, arguably with even less domestic resilience.
Exactly.
It is entirely a global phenomenon, but with divergent policy responses. Look at the European Central Bank, the ECB.
Right.
Based on their recent communications, they are holding their policy stance completely steady in March. They are actively and explicitly choosing to look through this recent energy shock.
Which means what exactly in central bank parlance?
It means they acknowledge the spike in oil to $100, but their economic models classify it as a transient geopolitical event rather than a permanent structural shift in aggregate demand. Therefore, they are refusing to hike rates into a war-driven energy surge that is already compressing European industrial activity. They are essentially holding their breath and praying for de-escalation.
But the U.S. Federal Reserve does not have the luxury of simply holding its breath.
No, because they are about to walk headfirst into a massive multi-day data gauntlet that will force their hand.
The data gauntlet. Let's lay out this specific timeline, because if you're managing a portfolio, hedging exposure, or even just tracking the macro environment, these are the exact dates and times where market volatility is going to absolutely peak.
Write these down.
On March 11th, we get the February Consumer Price Index, the CPI.
Yep.
The very next day, March 12th, is the Producer Price Index, the PPI, which gives us the wholesale inflation pipeline.
Which leads right into
March 13th, bringing the JOLTS labor data, tracking job openings and labor market tightness.
And it all culminates in a massive binary event on March 17th and 18th with the FOMC meeting.
Where the Fed will announce its interest rate decision and release its updated summary of economic projections.
That sequence of data releases is an absolute minefield for risk assets.
Let's extrapolate the potential scenarios here.
If the CPI and PPI prints come in hot, meaning they show inflation remaining sticky or reaccelerating, the Fed is completely trapped.
And we have to remember a critical nuance about the calendar here.
Right.
These upcoming February data prints will not even fully capture the recent violent oil price spike we just witnessed in early March.
Exactly. So if baseline inflation is proving to be intractable before the Middle Eastern energy shock even registers in the data,
The Fed must remain uniformly hawkish.
they cannot even hint at cutting rates, regardless of the pain in the equity markets.
But here's the other side of that impossible coin. As we discussed earlier, retail sales data is rolling over.
The consumer is breaking.
Everyday Americans are rating their 401ks just to maintain baseline consumption. We are tracking auto loan delinquencies and credit card default rates, and they are rising aggressively.
Particularly in the subprime auto sector.
The consumer is completely tapped out. The pandemic-era savings runway is gone. So how does the Fed, under intense political and economic pressure, balance a tapped-out, debt-burdened consumer screaming for interest rate relief against a persistent inflation rate that simply refuses to hit that 2% target?
That is the multi-trillion-dollar question that is currently short-circuiting the bond market.
Yeah?
If the Fed capitulates, pivots, and cuts rates early to save the consumer and prevent a severe recession, they run the massive risk of letting inflation become permanently entrenched in the psychology of the economy.
Guaranteeing a lost decade of purchasing power.
But if they hold rates higher for longer to definitively crush inflation, they will almost certainly push that 4.4% unemployment rate substantially higher.
Deliberately breaking the back of the labor market and triggering corporate defaults.
It is the equivalent of walking a tightrope in a Category 5 hurricane. There is no painless exit vector from this policy trap.
So what does this all mean for you and your capital? How does an investor or a trader actually navigate an environment where the central bank is effectively trapped, where unpredictable war headlines are gapping oil prices 10% in a single session, and where physical gold is relentlessly printing all-time highs?
It's daunting.
Let's transition from the macro theory into the actual actionable technical levels and the deep market psychology driving current price action.
To navigate this, we really have to start by breaking down the specific technical levels for gold, because it is the undeniable standout asset of this regime.
For sure.
The short-term market structure for gold is best described by technical analysts as up but jumpy.
Up but jumpy, I like that.
It is highly reactive to intraday news flow regarding the Middle East or inflation data, but the underlying medium-term trend is undeniably ferociously bullish.
So if you're analyzing the charts to manage risk, you need to identify the key support floors.
Exactly. The specific price levels where institutional buyers are algorithmically programmed to step in and accumulate if the price experiences a sudden pullback.
Right, the technical safety nets that prevent a dip from turning into a structural collapse. Break those levels down for us.
The first major technical safety net is the 50-day moving average, which is currently sitting at $5,298.
$5,298.
As long as gold maintains daily closes above that specific level, the medium-term bullish trend remains completely intact and healthy.
Okay, what if it slips below that?
If price action slips below that, there is a much deeper, more established support zone clustered around the 5,261 Alara level.
Where the market has previously established equilibrium and found strong balance between buyers and sellers.
Right. But the absolute critical line in the sand for this entire secular bull market thesis is down at $5,160.
$5,160.
That represents the 200-day moving average.
And if gold breaks and closes below that level on high volume,
then the entire structural narrative we've been discussing fundamentally shifts. And the massive institutional trend followers, the CTAs and momentum funds, will likely begin aggressively dumping their long positions.
that maps out the downside risk perfectly. But what about the upside momentum? If the stagflation narrative takes full hold and central bank buying continues unabated, where is the technical ceiling for this move?
The immediate upside resistance target that traders are targeting is $5,380.
Okay.
If the price action breaks forcefully through that ceiling, it enters a highly volatile price discovery band between $5,419 and $5,450.
And if the macro data aligns in the worst possible way for fiat?
meaning the upcoming CPI data stays scorching hot while the JOLTS data shows a collapsing labor market.
Essentially screaming undeniable stagflation.
Then the ultimate mathematical target is a retest of that massive historic 52-week high of $5,595.
It's incredible to even conceptualize gold nearing the $5,600 mark, given where we were just a few years ago.
It really is a paradigm shift.
But let's pivot the lens away from precious metals and look under the hood of the broader equity market, because the rotations happening beneath the surface of the major indices right now are giving retail investors absolute whiplash.
It is a mess under the hood.
We are seeing this incredibly aggressive, bifurcated, risk-on, risk-off dynamic play out simultaneously within different sectors.
Yeah, for instance, prime brokerage data shows that massive hedge funds are executing these massive multi-billion-dollar pairs trades.
They are going aggressively long on the semiconductor sector, piling into companies like Micron and NVIDIA.
While simultaneously heavily shorting the enterprise software sector as their hedge.
Yes, and this structural reality creates incredibly confusing, frustrating trading days for the average investor who is trying to trade on fundamental news.
Which raises an important question about market literacy. Why is the equity market behaving so erratically on a micro individual stock level, even when the broader macro environment seems calm?
Exactly. You might see a highly rated, structurally profitable software company like Salesforce ticker CRM report a fantastic quarterly earnings beat with raised forward guidance.
And yet the stock instantly dumps 3 or 4% at the open for absolutely no fundamentally obvious reason.
I see this exact scenario causing absolute outrage on investor forums every single earnings season. Retail investors buy the dip on a fundamentally solid software stock, assuming they are getting a rational bargain based on strong cash flows.
And it just bleeds out continuously.
Meanwhile, they watch the overall S&P 500 index stay perfectly flat or even tick higher because the entire weight of the index is being synthetically propped up by just a handful of mega-cap tech stocks and those specific semiconductor giants you mentioned.
It feels detached from reality.
It does.
But it feels detached because it requires critical thinking about the difference between fundamental market noise and structural market mechanics.
Right.
The reason a stock like Salesforce drops, despite reporting stellar earnings in this specific environment, often has absolutely nothing to do with the company's actual business performance or management.
It has entirely to do with institutional structural positioning and derivatives hedging.
We have to examine the implied volatility in the options market to really understand the equity market.
Okay, let's look at the VIX.
Right now, the VIX, the market's primary fear and volatility gauge, is hovering persistently near the 28 level.
In historical context, that is a highly elevated state of constant anxiety.
It dictates that market makers and options dealers are forced to heavily, dynamically hedge their massive option books.
When systemic volatility is sustained at that 28 level, algorithmic pairs trading and forced dealer hedging, specifically gamma hedging, drive wild intraday price swings.
Swings that completely overpower and ignore the actual fundamental news regarding a specific company's earnings.
It's the ultimate example of the tail wagging the dog. The massive derivatives market is forcibly dictating the price action of the underlying equities.
Exactly the mechanism. If a massive multi-strategy hedge fund is algorithmically unwinding a massive pair trade,
Meaning they are forced to sell their software longs in order to buy more semiconductor exposure based on a macro risk model.
they're going to relentlessly crush the price of that software stock through sheer volume.
Completely, regardless of how spectacular its earnings report was that morning.
As a participant in this market, you have to develop the awareness to recognize when your position is simply caught in the crossfire of massive institutional portfolio rebalancing.
Rather than signaling a true deterioration in the fundamental intrinsic value of the underlying business.
Exactly.
Okay, let's take a collective breath and zoom out to the macro view.
We've covered a lot of ground.
We have covered an immense, complex landscape of data in this deep dive. We started by dissecting the massive geopolitical shockwaves emanating from the Middle East.
Tracking how a threatened Strait of Hormuz spiked oil over $100 a barrel.
We then analyzed how the taco trade, the algorithmic realization that Trump was eyeing the exits and floating Navy escorts, manually slammed the geopolitical fire alarm off.
Sending oil plummeting back down to the 80s and allowing equities to momentarily breathe.
From there, we explored the profound systemic implications of the growing decoupling between the US dollar and physical gold.
We tracked how the DXY initially spiked on a mechanical, petrodollar-driven dash for cash, only to fall back as oil cooled.
Yet gold entirely ignored the de-escalation narrative. surging past the $5,200 an ounce mark,
Driven by an insatiable structural demand from sovereign central banks like China.
who are clearly and deliberately hedging against a dollar-centric clearing system and a deteriorating U.S. fiscal position.
We looked at the underlying, deeply concerning weakness of the domestic consumer, too.
Highlighted by the alarming rate of everyday Americans draining their 401k accounts just to survive the current cost of living.
And we mapped how that localized economic pain contrasts with the institutional rush into left-tail safe havens,
Furthermore, we outline the looming historical threat of 1970s-style stagflation.
detailing how it traps a Federal Reserve that now looks likely to deliver only one meager rate cut this entire year.
All while attempting to navigate a brutal upcoming data gauntlet of CPI, PPI, and JOLTS reports under the shadow of a potential new Fed chair.
And finally, we decoded the mathematical and technical realities of the current market structure.
We defined the critical moving average support levels for gold at $5,298 and $5,160.
And we exposed the frustrating reality of equity sector rotations.
We detailed how algorithmic pairs trading and heavy options dealer hedging, exacerbated by a VIX hovering near 28, can cause fundamentally fantastic companies to gap down on strong earnings due purely to institutional plumbing rather than business reality.
Right.
For you listening, the paramount takeaway from all of this data is this. In a hyper-financialized market characterized by dominant algorithmic trading, massive options positioning, and violently unpredictable geopolitical headlines,
Understanding why an asset like gold or a specific software stock is moving is exponentially more important than simply knowing what its current price is on a screen.
you have to understand the mechanical plumbing beneath the surface to survive the volatility.
It is the absolute prerequisite for surviving, let alone generating alpha, in a highly complex, multivariable macroeconomic environment like the one we are currently navigating in early March of 2026.
I want to leave you with a final provocative thought to mull over as you analyze your own portfolio allocations this week.
This is the big one.
If the ultimate undisputed global safe haven is quietly but permanently shifting away from the fiat currency of the world's largest economy and decisively moving toward a physical, unprintable metal that yields absolutely no interest, what does that signify for the global balance of power over the next decade?
Yeah.
Are we simply witnessing a temporary wartime market anomaly that will revert to the mean, or are we living through the quiet mathematical restructuring of the entire global financial system?
It is the defining macroeconomic question that every serious allocator of capital needs to be rigorously analyzing right now.
It's been an absolute blast unpacking the mechanics of all this data today. Until next time, keep your eyes on the macro data, watch those critical technical support levels, and stay endlessly curious. Take care, everyone.
Goodbye and trade safe.